We've got Tom Vosa, who's Head of Market Economics at National Australia Bank Group, joining us on the show from London. Tom, many thanks for joining us on the show. To begin with, whichever way the elections go, I beg your pardon, there's a view that Greece will run out of cash by the end of August, and an exit from the euro is now more a question of when rather than if. Would you agree?
Not quite. If we accept J.K. Galbraith's view that politics is the art of choosing between the disastrous and the unpalatable, then it's fair to say that so far most politicians have chosen the former rather than the latter course. But it's by no means clear that an exit by August for Greece is indeed inevitable. I think if we do see the austerity parties win the 17th of June election, then there's clearly quite a lot of scope for the IMF and the EFSF and indeed the EU Commission to advance more funding towards Greece. I do think that we'll see some compromising on the austerity plans. Remember that last year Greece actually reduced its deficit over the past 2 years by about 11.7 percentage points rather than 11.4 that had been asked for by the Troika. So I do think a compromise here is possible and indeed acceptable. So it's not all over. I think the key question we have, and this goes back to the election, is of course, do the Greeks really wish to continue remaining within the euro?
Now, Tom, with the ECB having got in the way of Spain's proposal to bail out Bankia, and with Spain now having to go to market to raise money for its banks, how easy is it going to be for the country? No one for even a moment believes that Spanish banks have worked themselves even halfway through the crisis.
The main problem we have now for Spain is that they've announced now that Bankia will be recapitalised by the FROB. The FROB, of course, only has 9 billion euros worth of money left, and Bankia needs about 19 billion. And how on earth will the Spanish government then raise money for the FROB to recapitalise Spanish banks by all the way through? Certainly we're looking at, if you think that Bankia is perhaps 19 billion euros, then perhaps we need another, sort of 31 billion euros to take care of the rest of the banking system. We know that PE rate, the book value for banks are fairly low, so no one really wants to issue shares, so it's up to the Spanish government. The problem Spain has is the flattening of the yield curve that we've been seeing over really the past few months. Not only have 10-year yields risen to above 6.5%, but 2- and 3-year yields are also rising, and that means it's getting increasingly expensive for the Spanish government to raise funds.
Now, Tom, Italy was forced to raise 6-month money yesterday at a coupon that was 20% higher than a few months ago. Do you worry that Italy is going to be the next pain point for the financial markets?
It's possible on the basis that sort of contagion seems to spread everywhere, but the fundamentals of all of these countries really are very different. Yes, Italy has a debt-to-GDP ratio of around 120% versus Spain's 70% at the moment. So on paper it looks to be a bit weaker, but the Spanish government has run a primary surplus. Certainly the caretaker Prime Ministership of Monti has pushed through quite a lot of structural reform in Italy quite quickly, which should aid long-term growth prospects, and Italy is wealthy. Essentially, the Italian government can finance most of its debt internally. It could reduce its debt-to-GDP ratio down to 100% if we just saw a wealth tax be put through.
Right, and Tom, also commodities, just focusing on that space, they had a dream run over the last decade, but given the current global environment and the bleak outlook, can we expect to see a substantial correction in commodities? Copper is already down 13% over the last 3 months. Brent crude, that's down 14%.
I think oil is perhaps a market where there could be a structural break, and that's really related to the use of sort of gas fracking in the United States. If we look at the 5-year forward for oil prices, that's really diverged from the spot price, which has gone up in recent months, I think due to geopolitical tensions with Iran. Now it's coming back down again. The 5-year forward price hasn't budged an inch, and I think with oil we could see lower prices, and that's due to a wholesale change in cheaper energy coming into the US, still the world's largest oil consumer, and if gas fracking takes off, then we could see lower energy prices. But food prices and perhaps even metals, we've still got a global economy growing at 4%. We're still seeing rapid urbanisation. That tells me that commodity demand is not going to go away anytime soon.